The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, Friday the 22nd of August. Welcome back, Jeremy. Good to see you again.
Hi, yeah, good to be here, Gareth.
So I normally say it's been an interesting and exciting week, but actually this week's been a bit strange. There's been not a huge amount of news across the board.
Sort of the dog days of summer, isn't it?
It is. It really is. So it's been a very quiet week on a lot of fronts. I know there's a little bit of politics that I'm sure we can talk about and the big Jackson Hole discussion to have. But before we get into all of that, where do you think the world's heading? What's going on with, in particular, the on-off potential ceasefire in Ukraine?
The ceasefire that didn't happen.
Yeah.
So, I guess last week we were all focused on the comings and goings in Alaska, which failed to achieve the stated US objective of a ceasefire. Then we had this sort of rather odd meeting in Washington where Europe's leaders didn't allow Zelensky to go to Washington unaccompanied. So worried were they that he would be bullied into capitulation. I mean, it was Max Hastings said that Trump has discovered that it's easier to bully allies than to bend enemies. So, I would say watching the clips, the coalition of the willing looked more like the coalition of the supine as they all sort of grovelled at the feet of the Donald. But we all have to sort of live in this fantasy world that I think European leaders live in, that they're doing enough to keep a Ukrainian sort of peace process on the rails, despite zero sign, I would say, of Putin to meet anywhere approaching middle ground. But Donald was on his best behaviour in the White House. There was no reruns of the last time Zelensky visited the White House. And I guess that was probably helped by the fact that his main attack dog, J.D. Vance, was on holiday in Europe.
That's true. We've probably had benefit for the lack of fishing licence.
Yeah.
The UK Treasury suffered last week, but at least Zelensky didn't get the beating up that he experienced last time.
I don't think we've got anywhere. And,
No.
There doesn't seem, to my mind, to be any obvious road from here to peace. I mean, the two sides seem to be poles apart, and I can't discern any common ground at the moment.
Which is a shame, because apart from the obvious benefit to humanity and the poor people of the Ukraine, I've been hoping for some time there would also be quite a significant benefit of plentifully cheap Russian oil and gas flowing once again, which would help bring inflation down. And it feels like at the moment, inflation is very much is anything but down. So we need all the help that we can get.
I think you've got to be sort of careful what you wish for on that one, because part of the hypocrisy of all this from Europe is that Europe is still buying large quantities of Russian energy. So even if we were in a position where a ceasefire or better were in prospect, I'm not sure that it's going to lead to this collapse in energy prices that some of the bulls might be hoping for. But meanwhile, back in the real world of what's happening in the economy, certainly as far as the UK is concerned, the official UK inflation measure came in at 3.8% for July. In old money RPI terms, it's 4.8%.
Yeah, it's easy to forget that that's shifted, isn't it? Yes, that's right.
Either way you look at it, the rate of inflation that the UK consumer faces is approximately double the targeted level. And despite that, the latest move from the Bank of England on interest rates was down. We've now had 49 of the last 51 months above target. And over the last 12 months, inflation has gone from 2.2% to 3.8%, during which time the Bank of England has cut policy rates by 100 basis points. And in the same time period, the UK 10-year yield has risen by 90 basis points from 3.9 to 4.8%. So in short, the indicators from the bond market is that we're at risk of losing control of the long end of the gilt market or our control of inflation, or both. And that is a picture that is probably more extreme in the UK than in most Western countries, but it's a feature for everybody.
It is, yeah. So we're sitting thinking about interest rates and inflation in the long term. What's worrying people in the short term? It feels like that the budget is beginning to loom, even though it's not very soon.
As I think we said last week, we've got a long haul now for the UK because there seems to be daily speculation about tax increases in the autumn budget to try and tackle head on the UK's sort of fiscal dilemma. And the focus this week seems to have been on the prospect of some form of increased taxation on the UK residential property market. If there's a bigger trigger subject for the UK's commentariat than house prices, I don't know what it is. But
No.
that sort of filled quite a few column inches this week. But without being too doomerish, I mean, Rachel did get some good news this week. UK government spending exceeded revenue by 1.1 billion in July, which compared with a figure of 3.4 billion a year ago. So it means that year to date, her fiscal plans are more broadly on track than most people until recently have been giving her credit for. It does in no way take the pressure off her requirement to raise more taxes or cut government spending come the budget, and the balance of probability remains firmly in the camp of tax increases rather than spending reductions.
But at least the short-term spending hasn't gone wildly out of control, which would have been just yet another problem for her to deal with. Yeah. Okay. And what about in the US? What's been going on across the pond?
Well, we had minutes from the latest Fed meeting, which intensified fears that the central bank there might not implement the scale of policy easing that had been previously anticipated. And we've had what some in the press have been calling a tech rout, in the sense that we've had, I think, 5 or 6 consecutive days where the NASDAQ has gone down. Overall in the week, I think it's down 3.3%. So maybe you might want to call it a correction, but such is the recency bias of people expecting that the Mag 7 only go up.
Mm-hmm.
This is perhaps the beginning of a reversal. And I think we've reached a state this week where we've gone slightly risk off, certainly seen a correction in some of the excesses of the bull market for technology stocks in the US. But we haven't really reversed engines. And I think things are really being put on hold because the focus of attention for those people who are still in the markets during these dog days of summer is now going to be really focusing on Jay Powell's speech at Jackson Hole this afternoon, UK time.
So what are we expecting, and how combative do you think Jay might be in his words? Because he's been battling a fairly aggressive Donald Trump.
I mean, it's his last hurrah. His term as chair of the Fed ends by May, and there's obviously been lots of speculation as whether that date will be brought forward. But I think what people want to know about today is whether Jay is going to stand and fight. Is he prepared to die on this hill of inflation by keeping rates on hold next month? Or is he going to give in to the pressure that has been applied over recent weeks and months from Trump and Bessent? In many ways, this is the last stand of monetary policy in a world of growing fiscal dominance. And while most commentators are hoping or expecting that he pivots and concedes, of course, we don't yet know who will replace him. But what we do know is that they will be dovish. They will be an uber dove because that's who Trump and Bessent are going to choose. So why stand and fight? But he's got to be thinking about his legacy. And one of the things you've got to bear in mind that today isn't the decision day. Today is the day for Jay Powell to give us some clues, stripped back of his usual responsibility in FOMC press conferences to reflect the wider views of the recently more divided FOMC. So in the short term, much is going to depend on how the longer duration bond market takes it. And whatever he says, particularly if he says he's going to stand and fight, or words to that effect, and these are going to be nuanced comments rather than overt statements, of course, at the long end of the bond market, just like in the UK, just like in Japan, just like in Europe, it doesn't look promising. You know, the wider world, policy rates have been tumbling. The Fed is the standout on this. Powell has resisted where others have caved. Mm-hmm. And as policy rates around the world have tumbled, longer dated bond yields, just like in the UK, have risen. And so this is the gauge, I think, that people need to keep an eye on.
Yeah, a lot to play for. And as you say, it's his legacy that's at stake. So it's a fine line, because I guess, ironically, it might be that he would be prepared to be a little bit more dovish. But because Trump has made that so clearly what Trump wants and so aggressively battered Jay Powell, it might mean that Jay Powell deliberately, to stand up to Trump, is actually a little bit less dovish than he might otherwise be. So Trump's battering ram might be quite ineffective ultimately. But
I would agree
wait
with
and
that.
see.
Absolutely. What have you been looking at this week?
So we normally talk about the small micro cap end of the UK market, but this week the one standout piece of news has been the warning from WHSmith, who came out midweek with a very short and quite, in some ways, imprecisely worded RNS describing some issues they discovered in their North American business, where it looks like they've been incorrectly recognising supplier rebates on quite a large scale, such that this year's profit from North America is now expected to be 25 million compared to previous expectations within the business of about 55 million. So a 30 million pound shortfall just in that North American division. And overall, that's had a pretty major impact on the group PBT expectations. So that the shares fell, I think, give or take 40% on the back of the news. And it's, really quite shocking.
It was one of the most decisive share price declines I've seen in a long time. I guess one of the issues here is we don't know how long this has been an issue, and therefore we don't know whether the reductions in guidance that have been interpreted on the back of this quite short update, whether they're sufficient.
No, that's right. It's interesting because people often ask, why do investors not like companies which have low margins? Why do investors like high margin businesses?
Yeah.
And one of the reasons is that in a low margin business like WHSmith, it doesn't take much of a surprise or a shock to make an absolutely huge difference to your profitability. And absolute case in point, these are, I imagine, in the scheme of things, relatively small percentage discounts or rebates that they're receiving from some of their suppliers. But because they're talking about billions of pounds or dollars, that soon adds up when you're looking at a group that as a whole might still make profit before tax. They're talking about 110 million. So a couple of percentage points on numbers up in the billions, and it makes a massive difference on your overall profitability. So you don't need to make much of a mistake when you're running such a large and revenue managing business as something like WHSmith. So it's interesting. And they haven't talked about whether this is just a one-off thing during this current year. So it might well be that there are restatements or reductions to be made for previous years. I think the assumption is probably that if this £30 million hit just relates to this year, you'd probably take a similar amount off the future years or the forecast or people's expectations of the overall sort of run rate profitability of the business. And I'm sure that, alongside the obvious impact in terms of credibility and reputation, that's why you've seen such a big share price fall. But did you mention there's a relatively new CFO in WHSmith?
Yeah. I mean, not just from a financial position, but from a strategic position, this couldn't have come at a worse time. The WHSmith that we know and love from decades ago on the UK high street, that business has been sold. And the focus of WHSmith has been purely on the travel division, where it has made acquisitions in the States, two that I can think of in the last 7-8 years or whatever it is. So the strategic focus has been on the area where they've got the difficulty. And just at the time as they've sold Funky Pigeon, they've sold the UK high street business, just at the time they're focusing all their attention on the potential growth in US travel to be able to replicate their format across airports in the US. It seems to have gone wrong. And as you say, it seems to have coincided at a time when a long-standing CFO who's been there for many years has retired and been replaced by a new CFO. So very often, I think you might see that when that process happens, double checking on financial controls, double checking on processes, what do you know? A skeleton has fallen out of a cupboard somewhere.
Yeah, we have to keep an eye on that over the next coming weeks. I think the year end is the end of August, so presumably they'll give us an update probably not long after that.
Yeah. Okay.
Well, Jeremy, thank you very much for that. Great to catch up as ever. I understand there's not a huge amount of news flow expected next week, so we'll catch up this time next Friday and probably talk about Jackson Hole, whatever else has happened in the meantime.
Okay.
Good stuff. Talk to you then.
See you then.
Brought to you by Progressive Equity.